And welcome to the second hour of TheoTrade. I am Professor Jeff Bierman. I am broadcasting you live from Chicago. And today is Monday. It is August 24th. It is 2026. Good morning to the usual suspects out there who seem to live at TheoTrade. We love it. We never want you to leave the platform if ever you can. So stick around. And I see the usual suspects, John Fleck, Erez. Erez doesn't live that far from me, but I don't know why we live in Illinois. I know why I live here, Rez. My wife's held me hostage with my daughter until she gets through high school. I can't speak for you. Needless to say, we're going to get through part 3 of a coaching session today on managing losses. There's so many ways to go about it. There's not one right way to do it. There's formulaic, there's optical, there's simple, there's complex. I'm just here to provide like a complete potpourri of ways of going about it. But the important thing is, if you can't manage your losses, you have no future in this business. And a lot of people find out the hard way, either by over levering or biting into the perma bullish news agenda, which is the market's never going down, which is crap, because everything eventually cycles, everything eventually crashes. It's the nature of the business. You just have to make sure you're out in time and not live the fantasy world. But in the meantime, let's get into the market theme of the day. Listen, I know a lot of you once upon a time, and the theme of the day is cliffhanger. Obviously, you kind of know where I'm going with this. A lot of you probably remember, and this is back in 1993. So let me jog your memory for those of you out there. In 1993, there was a really fun film, and it was called Cliffhanger, starring Sylvester Stallone. It also had John Lithgow, who played the arch enemy or arch criminal at hand. It had Janine Turner. It had Michael Rooker. It had a really good cast of characters. So this is the kind of cliffhanger I'm starting you off on. Let me bring a visual in play. There's Stallone. You know, he's always ripped. I think, what is he, close to 80 now? He's doing Tulsa King. There's the helicopter of the thieves who stole money from the Treasury in Denver. And you can see him, out there in his studly buff body, and he's hanging by a thread on the cliff. I mean, there's not much more to it than that. But the type of cliffhanger, apart from this kind of like setting the tone picture, the real type of cliffhanger I want to talk about is the definition as it relates to movies and as it relates to books and as it relates to thematic, could be plays, entertainment, and whatnot. The true meaning of cliffhanger in the idiomatic sense is that a cliffhanger is an ending, and you can see where I'm going with this, because this bull run we're having, it's coming close to an end. It's an ending to an episode of a serial drama that leaves the audience in suspense. It leaves the audience in suspense. Another way of describing it is a story or event with a strong element of suspense. So it's clearly, you have to like latch on to where I'm going with this. I can't go that much like, deeper figuratively than this. You're on a cliffhanger. You're not on a bender, which means you're out getting drunk and you wasted the weekend, you have a hangover. You're on a cliffhanger right now. The Fed's not stupid. The Fed clearly sees what's at risk here. That gap at 76.35, that's the end of this run. We'll probably, if we break it and we roll and the indicators in my trading model come together, we're likely to find ourselves at 7,300. It won't go down in a straight line. It's defended by algorithms. It's rigged. It's manipulated. Don will tell you this. We'll probably go down to 73.25. And if we go lower, it's just because of margin calls. The Fed can no longer do it's feckless. And then you get that, all of a sudden, that seasonality weakness. But we're walking our way down there. I am not one to go out and stick my neck out like a moron and tell you it's going to break tomorrow. I have no friggin' idea. If I did, I wouldn't be sitting here. So don't send me an email. I don't know. I'm all about setups. And when setups fall into place, what we call inside the burn signal, and Jessica, we call them footprints, or we call them thumbprints. When you see the footprint or the thumbprint, it means the probability elevates. It just elevates that a certain outcome is about to occur. It doesn't say we're going to crash. It doesn't say we're going to the end of the world. That's not what it says. It means we're going to move from point A to point B, because markets, that's what they do. They escalator up and they escalator down. This is not your grandpa or grandma's market, so shut up and stop it. It's not. We're not going to gap down 1,000. Not now, not ever. Okay? The Fed will never let it. The SEC will never let that happen. But there will be days where we could be down 300 to 400, which is 2 to 3 to 4 or 5%, and we get some type of stoppage circuit breakers. But we're right now at the edge. We're right there. We're on a cliffhanger. You're still on, you're hanging. You're right there. Now, what do? Okay. You obviously have to map things out technically, because fundamentally, you've got nothing holding you up here. Okay. You're in a massive bubble in many sectors. You're starting to get to a bubble in financials. You started to get to a bubble in tech, but that bubble's been burst, which is good. You're in a bubble in industrials, clearly. Retail is not in a bubble, and neither is areas of telecommunications, but you do have a bubble in utilities. But neither here nor there. You're now in the official downward. You're in a descending channel. It's called a descending channel. Algos have taken over. You've lost support. You've lost slippage. It's gone. Bye. It's gone. You're not going back up there. Now what? What are you going to do? Okay. We're right now on what's called a hammer. A hammer is not a sell signal. I want to point that out. It's not. You're going to have algos and Citadel and BlackRock rig the market and defend as much as they can. They're not going to let this try to go down. But if it does go down and take that out, okay, the algos will no longer defend. They only defend up until the point where the slope integrity changes. You're right at the edge. You've got a descending channel. The horizontal's holding. But you, at this point, you defer to the dynamic formulaic indicators. The RSI is barely holding 50. You're right on a cliffhanger, people. You're right there. If it goes through 50 and drops to 40, 7,600's gone, and you're going to shit the bed. It's gone. It will not even, it'll go to 75 by the time you blink. Watch that RSI. That algos defend the RSI, but if it goes to 45.40, they won't defend it. They'll walk it down. The MACD is now crossed underneath the signal line. That means that momentum is bearish, but the trend isn't bearish. But momentum turns before trend. If it can break away and create what's called histogram deltas and pivot hockey stick, bye-bye. Now you're at 7,400, and the cliffhanger there's no more suspense here. It becomes more obvious day by day by day. The last piece of the puzzle, which is the most important, is the money flow. I have said this a million times. The money flow never lies. CNBC lies. People on Bloomberg lie. Portnoy, all these people on social media, they just lie. They lie to get it up. This will not lie. That is not bullish. It's not wholly bearish, but you've lost liquidity support in the market. I'm going to quote Kaufman. There's no buyers here. You're the only buyer, people. If you're buying this product, you're the only buyer. Good luck. You can swing it. You can trade with Corey. You can trade with Gianni. You can trade with Tony Rago. But you have to be aware that the risk reward is not in your favor, and you're on a cliffhanger right now. I take it day by day. Oh, I never take things minute by minute. I take it day by day. So this is just getting slowly worse day by day by day. I then flip to the weekly. The weekly is in a topping process. The weekly is starting to curl over. So if the weekly takes out the 50, if the weekly gets underneath the signal line, and if the weekly pivots down here, you've got yourself the first correction you've probably had in 2 to 3 years or a year and a half. So right now, you're on a cliffhanger. It's suspenseful, but on a cliffhanger, has Stallone fallen off the cliff? He has not. Has the market fallen off the cliff? It has not. It's a cliffhanger. But if the market goes through 7,500, it's no longer a cliffhanger. It's a fait accompli. It's a done deal. There is no more suspense. You are going to probably go lower. Now, as far as the macro kicks off today, I'm going to bring this to clarity, which Kaufman was not quite able to do. Okay. I call this do or die. You've heard the expression. It's a do or die moment. Hartnett, again, I got my 5 guys. 99% of Wall Street's full of crap. They're brain dead. Hartnett's brilliant. McElliott's brilliant. Okay, there's a lot of smart people out there. He works for Nomura. Hartnett works for B of A. These are quant jocks. They're quant gurus. They're not bullish or bearish. They just give you the quant, the data, the hardcore mathematical data, and then you just go with it. Hart is commenting on Besant. What Besant's doing, according to Hartnett, is called quasi-QE. So let me jog your memory a little bit and take you back to a time. QE means quantitative easing. So what the Fed is doing right now is a quasi. They're not saying we're doing quantitative easing. That's exactly what Dunderhead Powell said out loud. This isn't, they're admitting it, but it is. It's quasi. Quasi means it's QE, but we're not going to admit it. Here's the thing that Hartnett pointed out. The success of this program is expected, but the failure is unthinkable. Quote, let me quote what Hartnett said so you understand better. Hartnett has framed Treasury Secretary Scott Bessent's expanded long-term Treasury buybacks as quasi-QE, a bond market intervention designed to relieve stress on the long end of the curve without restarting the Federal Reserve quantitative easing program from the beginning. Hartnett sees this as part of a broader Bessent put, like a put option to protect the market's expectation that the Treasury will act to defend government financing when yields threaten affordability, housing, or asset markets. Where clearly it's affecting affordability and it's affecting asset markets and housing, all three. So Bessent's jumped into the fray and says, don't worry, I'm going to rig the market. I'm going to control this sucker. He is micromanaging the market right now. Hartnett's warning, his central warning, is that the 30-year Treasury yield cannot be pushed below 5%. That is Bessent's goal, to get the 30-year below the 5 handle. The policy's credibility will falter if he cannot do this, and he warns that failure to meet this target could weaken the dollar, triggering an accelerated position in leveraged risk assets. That means if they can't get it below, the stock market's toast, and you're going with it, you S&P people. You're going with it. Don't challenge Hartnett. The guy is smart. He can't tell you when or how. He's just telling you these are the risks and this is the outcome if he cannot get it below 5%. He also said, quote, he's encouraging selling AI hyperscalers, private credit, and financial assets, which are competing with treasuries for long duration capital. So what he's telling you is that at some point, if they can't get it below 5%, okay, it's going to basically drive the AI hyperscalers down, which you see it happening right now. It's going to drive down private credit, which you've already seen, and the financial stocks are going with it. So right now, these financial stocks that you're dip buying, I advise you to stop it. Stop it. Stop buying them. You're buying bubbles. I'm short 2 bank stocks with PEs of 20. They're going to blow up. They're going to crash. You can't have financial assets above a multiple of 17. You cannot. I've been doing this for 30 years. You cannot. They cannot grow at these levels. They are risk assets that need to trade between a multiple of 8 to 12 and 15's a push. So now these financial assets are at risk. Some of them popped and now they're finally selling off. Maybe somebody's listening to me. So I'm telling you right now, it's a do or die moment for the market. You're on a cliffhanger, and if he can't get it below 5%, we're going down. The next is this: mind the AI gap. And people say, well, what do you mean that? Well, mind the gap is an expression that's thrown around in England because, like, you know, and I've been in England 3 out of the last 4 years. I'm actually going back next year again because it's a leeway to where it's a gateway because I need to get to Southampton to Belgium on one of my trips. I'm telling you, they have a mind the gap means as you get on the underground subway, the tube, okay, there's a gap between stepping on the platform to the train. Mind it so you don't get your foot caught and torn off. Anyways, mind the AI gap. Okay, Goldman Sachs is warning that the AI momentum cracks. Hard assets have already cracked the hard assets. You're seeing all these hard assets. Nvidia, you haven't seen Apple because they're not AI, but you've seen Micron, Advanced Micro, all of them, SanDisk. What do you notice about all the hyperscalers? What do you notice in Meta? They're all coming down. They're all 10, 20% down, okay? The AI momentum has cracked. What's the next trade, according to Goldman? Hard assets. Goldman's telling you that the next wave in this market is gold, silver, and crypto. Crypto's not a hard asset, but they're throwing it out there as a tangential. I'm starting to wade into some of the hard assets. I'm talking like oil. It could be wood, furniture, lumber, chemicals, whatnot. Start to look at inflation-driven assets that are a function of the dollar and interest rates. Goldman's telling you that on their trading desk, they're rotating out of tech and they're rotating their clients into gold and silver. I think that's the next directive move. That's where Gianni's going. I know Corey's looking at it. Start to look at hard assets. The AI gap is forcing your hand to get out of these paper assets that are very expensive and start to move into inflation-driven assets, which have value when inflation pops. And inflation, if it gets above 6 to 7, it won't matter what the Fed does because the market will sell off anyways. Remember, there's what's called nominal inflation and real inflation. The 5% that you're seeing on the market itself is nominal inflation. The real inflation is at 4%. But if we get to 6 or 7, that will push the real and the nominal through. Remember that. The last one, I call this one Fastflation. I think it's one of the niftiest, coolest things I've ever heard. I hadn't heard it till recently, but apparently fast food prices are rising faster than inflation according to research firm Finance Buzz data. So what does that mean? It says between 2015 to 2025, an analysis of 12 major food chains, found that the average menu price rose 60% and that it hasn't come down or ticked down at all. And there is no likelihood that they're going to go down. They're likely to go up from here, more than double the 31% national inflation rate. So for the 10 years between 2015 and 2025, the cumulative inflation rate was up 31%. But the food chains are double that. And what do people do day in and day out? They go to the bathroom, they brush their teeth, and they eat. And with food prices going up and beef prices at an all-time high, we are heading for some type of cluster mess in this economy. Even the wealthy are going to start to feel it at some point. You can start to really see what's happening here at the grassroots level. McDonald's saw its prices double. They're up 100%, which is the highest among all fast food chains that they studied. Popeyes is up 86%. Taco Bell's is up 81%. Chipotle's up 75%. Jimmy John's is up 75%. All of these doubled and outpaced inflation by more than 100%. Subway and Starbucks were the only two food chains with price increases under 50%, both at 39% respectively. So what I'm telling you is prices are outpacing inflation. Labor costs are up, ingredient inflation's up, rent and insurance is up, corporate pricing strategies up. Good luck, Mr. Besant, trying to get this down. You're not going to get the market down. You're not by raising interest rates. What you got to do at some point is, okay, you got to basically step in, bring the stock market down so people don't feel so wealthy, and then they'll start spending less. Because the stock market itself is a psychological wealth effect vehicle. So I just want to throw that out. We are in a very precarious position. How long is it going to take while Citadel manipulates the market and holds it up with the Fed? So it's Citadel and BlackRock and the Fed, and there's the rest. We're going to see. We're going to put the feet to the fire to the test. In the long run, fundamentals always win. In the short run, technicals are winning. Technicals are winning now, but we'll see how long that lasts for. I don't know. As far as individual stories are concerned, Viva Las Vegas! Anybody understand the pun? Every single one of my titles always has a pun somewhere in the title. This is no different. Tesla, okay, has a pun embedded. It's down 5 today. Anybody get the pun Viva Las Vegas? Okay. If you didn't get it, I'll bring it directly to you. Tesla's robo-taxi service in Las Vegas, which is the pilot program, is now officially permitted under Nevada's Autonomous Vehicle Network Company framework. The law has been passed. They have cleared the legal hurdle, but with strict limits compared to the company's initial request. So the company has requested a lot of leeway. The Nevada Commission said, no, we'll let you operate autonomous vehicles in Las Vegas with millions of people running around the strip. but there's only so much we're going to let you do. So on August 21st, which is last Friday, the Nevada Transportation Authority, the NTA, approved Tesla Robotaxi LLC to operate up to 10 fully autonomous vehicles in Clark County, including Las Vegas. It's a pilot program for the first year. This is a sharp reduction from Tesla's original application, which sought 5,000 vehicles. So the only reason why I'm throwing this out there is, okay, they're giving it 10, and if that 10 pass muster, they're going to start to open the door for more and more robo-taxis. So if you're thinking where Tesla's cash flow is going to come from is the sale of their cars, you're barking up the wrong tree. You're completely misdirected. Tesla's cars are not going to make them the money. It's the next generation of logistical movement of people, like a people mover. Tesla's on the forefront, where if they can succeed in the robo-taxis in Vegas, it will then spread and metastasize to Seattle, to New York, to Florida. This is the breeding ground so far for the robo-taxi. Let's see where this takes us. I know Waymo has got its own, but I think like a lot of people jumped on this on Friday when they got the approval. Oh, it got the approval. The problem is it's disappointing because they're only allowing up to 10 fully autonomous vehicles, not the 5,000 that Tesla initially requested. Just be aware of them. I'm just bringing it. So I call Viva Las Vegas. The next story that caught my attention this weekend, I call it take a hike. Take a hike. A couple of things to point out. So again, you can take it for what it's worth, or you can kick it back. It's totally up to you how you want to take this. I do not have a position in Nvidia. The Genesis cog, the burn signal, is rules of trading engagement. We are prohibited ever from taking a position ahead of earnings within a 2-week window. It's the dumbest thing ever because you're going to blow your account out eventually. You're better off not trading it. Or if you're going to take that risk, you have to do defined risk like a spread, an iron condor, or a straddle. Never step in front of earnings. You have no idea what you're up against, okay? They're reporting, just making you sure, they're reporting on earnings this Wednesday after the market. It is going to be a market mover. So my assumption is if they disappoint and the stock takes out 200, that will break the back of the S&P. That will finally take us through 7,500. It will get us through. But that's not what this is about. Okay? This is what Scott Bessent is worried about. You want to know what he's worried about? Okay, he's worried about food inflation. But now he's worried about something far more sinister. He's worried about technology inflation. Apparently, Nvidia alerted all of their customers, and they've got hundreds of thousands of them, that they are going to raise prices by 15% on their AI servers to offset memory cost expansion, which continue to soar. So guess what? Nvidia is going to raise all their prices 15%. Yay! Tesla's going to, Nvidia is going to make more money. But what's that going to do? It's going to lift up inflation, and it's going to kill Bessent's what? Buzz is what it's going to do. This might help beef their margins, but it's definitely not going to help their sales. It's definitely not going to help their public relations, and it's definitely not going to bring inflation down. So I'm warning all of you. We all know we have inflation in the broader grassroots Main Street economy. Main Street's suffering. But let's remove Main Street and let's take Wall Street. And Wall Street is AI. Wall Street doesn't care about Main Street. It has no interest. AI, if we have inflationary AI, that could be the nail in the coffin. So when B2B and B2C both have inflation, that could finally send Treasury yields through 6%. This is not something you want to hear. You want to hear that, Jensen Huang says we're going to hold steady. We got good sales. Raising prices might help their margins, but it's going to force the hands of everybody else in the industry to lift prices, and which actually could work against them in the long run. So now you've got Nvidia is now stoking inflation. That's not good for nobody. Next one on here, urge to merge. Urge to merge. Okay, it has been reported, and I'm just bringing this out there, that Wells Fargo and Citigroup are being pressured by a number of independent analysts to buy banks, to buy a big bank. to buy regional banks to fit the bill. Why? To compete with the JP Morgans, to compete with the BlackRocks, to compete with the other major Morgan Stanleys in the longer term. So I'm just throwing this out there. Citigroup and Wells Fargo are the only US mega bank stocks with room under the 10% national deposit cap to buy a large regional bank. So this is to warn you that if Citigroup or Wells Fargo decide to go out and buy banks, this will basically create an arbitrage situation, which will probably drive the stocks lower. So what I'm telling you is, I'm not saying to short Wells Fargo, because I'm not going to short this. Wells Fargo trades at a 12 multiple, which prohibits me. I will not short a 12 multiple. I will short a 19 or 20 multiple. I won't short a 12. But this tells me right now, if you're buying Wells Fargo, you clearly have your head in the sand like an ostrich, and you're going to eventually lose money if you don't pay attention. If Wells Fargo's on the hunt to buy a big bank because they're being pressured with Citigroup, what do you know? The stocks are not likely to rally because the arbitrageurs, the acquirers, which is Wells Fargo and Citigroup, that will keep the stocks down. So if you're wondering, why have these stocks not recovered? I just told you, because they're being pressured to merge with other regional banks, and that will continually put pressure on them because of the stat arbitrage players will do that. Don't buy these stocks. Don't buy Wells Fargo, Citigroup. Stop it. Don't buy them. Because if they make an announcement any day for a buyout, it could be like, who knows, US Bancorp, it could be something in San Francisco or Texas, smaller bank, that will drive these stocks lower. It's an arbitrage play. The last thing I want to throw out here is, and this is the interesting thing about this, and it caught my attention this weekend. I call this one lickety split. Now, a lot of you are not going to get this joke at all. You're going to be like, I don't get it. Okay, what does the word lickety split mean, anybody? Anybody? Okay, it's like a famous expression from the 60s and the 70s for chop chop, like arriba arriba, like andale andale, fast fast. Lickety split means right here, right now, in short order. Anybody catch the news on Airbnb? Any of you? Bueller? Any of you do any research? Raise your hand, please. Let me know in the chat. Do any of you do research? Because if you didn't, I'd fire you. You got to do research. You got to know what you're buying. Because if you don't, it'll, at the end, when you blow your account, you're like, oh, if I had known this, I would have never bought. Of course you wouldn't. Know what the risks are. Airbnb made an announcement. Did anybody catch the Airbnb announcement? Does anybody follow this? Okay, I'll bring it to you if nobody follows it. Airbnb, I'll go through 6 months. Look at the stock ripping higher. There's a reason why Airbnb is ripping higher, people. And it's not just because. It's not going up because of that. It's new high. Why? Okay. Airbnb changed their pricing structure. Airbnb now has what's called a 15.5% host-only fee. Okay. What does that mean? It means Airbnb is phasing out its split fee model with its clients or its vendors, the people it works with, like you and me, who may rent out our house. They're splitting the model and they're moving all United States hosts to a single 15.5% service fee model deducted from your payout. It means the old split fee worked like this. The host paid out -3% of the booking total. You had to pay it to them, and guests paid an extra 14 to 16.5% on top of your listed price. The new single fee model sets one price. Guests see the same price at checkout, and Airbnb deducts 15.5% from your payout. The change applies to all hosts in the US, including those who previously used property management software, PMS, or channel managers. Why is Airbnb doing it? To create greater pricing transparency. So the bottom line is that Airbnb is going to give you a lower payout, and they're going to retain more money. That's what it means. That's why the stock's up. They changed their pricing model for greater transparency, but who does it benefit most? Well, it benefits you because when you're paying at the close of the transaction, you know exactly without hidden fees, but ultimately it actually puts more money in the back pocket of Airbnb. Instead of a split model, it's a single model. That's why the stock popped, because it's going to abet their profit margins incrementally, And when you do it by volumes and billions of dollars, it means the stock's going higher. Would I short this? Hell nah. Is the stock expensive? Yeah. Is it a bubble? No. But it ain't worth 40 times earnings. I don't short on the way up. If you want to, good luck to you. I will not do it. Good luck. All right. Let's move upward and onward, and let's get to the lesson of the day. I think I've spent enough time talking about this situation. So what we're going to do today is we're going to keep it really simple, really rudimentary. We're going to talk about the art and science of cutting your trading losses, part 3. This is what I call the ultimate art. It's not much of a science, but it's the ultimate art of your trading losses. And there's a couple of ways you can go about this when it comes to the horizontal, and there's a couple of ways you can go through this when it comes to doing support levels. And we're talking about support levels only support. So we're talking about bullish charts only. We're not going to talk about the negative side today. The idea here is, and I've said this time and again, and we had a little piece on Friday that was a write-up, like as soon as you place the trade, you have to volatility map and identify your exit points. Because if you don't, you'll be a deer in your headlights for the rest of your life until your account dwindles to nothing. And you're going to ask yourself, why did I lose? Because you just don't know how to sell. Your ego is too big. You're too fearful. You're too lazy. You're too complacent. You're like I said, you're too full of yourself to admit you made a mistake. You have to take losses periodically in the business to replenish your account, salvage whatever capital you can get, and move on to the next trade. You have to have a very short-term memory. The two businesses which you have to have short-term memory: quarterbacking pro football, you throw a bunch of interceptions, you got to black that out, get behind the quarterback from the center, take the hike from the hike, and throw passes again. You got to have a real short-term memory to be a pro football quarterback, and you have to have a real short-term memory to be a trader like me. You have to. You can't let, I lost money. Yeah, well, everybody does. Stop. You're going to lose money on trades. The idea here is to pyramid. You get, even if you have losers and winners that are the same, if you have bigger winners and smaller losers, you end up a millionaire anyways. All right, so let's talk about horizontal and ascending price support levels. I will bring arbitrarily, and again, I try to bring as an educational point of stocks I don't have a position in. I just really, really, really don't have some type of position. So you know I'm not agendized in trying to like prove to you that I'm doing this. So I'll bring, let's see if Boeing will play itself out here. I could bring Boeing into the mix here. Okay. It's a volatile stock. I don't trade it. I want nothing to do with it. Nevertheless, I bring it to bear because it supports my, as an example, within the context of cutting your losses. You recognize when things are going up, okay, that there's two ways, there's two optics of always looking at stocks. Most people, and I'm not picking on you, most retail have what I call a blind spot. Your blind spot is you always look at things, okay, up to down, or you look at them horizontally. What I mean by that is you always look at things and say, well, you know, I'm willing to buy Boeing, but you set horizontal stops. You should. So the easiest way to go about trading anything, I mean, the easiest outside of just saying, hey, I'm only going to lose up to $5, or I'm only going to lose up to $200 in this trade, or I'm only going to lose up to 2% on this trade. That's like the most rudimentary way, which is like, that's the science. The science is you pick a loss by dollar amount, you pick a loss by percentage amount, or you pick a loss by the value amount as it impacts your overall portfolio. That's the easiest way to do it. The other alternative, which is not the science, but the art, is to draw horizontal levels. I do this constantly. My whole life is horizontal levels. So if I look at Boeing, all you have to do is draw horizontal lines where there are clusters of what I call points of what I call rappel. And we're only focusing here on what we consider to be bullish charts. So you're going to draw support levels. So how would one go about doing this? Okay, right over here, this would be conceivably, and it's optically, one support level. Why is that a support level? Because it bounced right off that at 187.72 and it took off for the hills. Support levels simply represent, it's a liquidity node. where the buyer has the upper hand. There's more liquidity to buy than there is liquidity to sell. Once you change that imbalance, it's called equilibrium. So at this point right here, it's where 50% of the traders are long and 50% are short. Sellers and buyers come together, and when it flattens like that, it means you've changed the actual like proportionate from, let's say, 70-30, 60-40, okay, 55-45 to 50-50. There's enough sponge in that liquidity to absorb it and defend it at that lower level. That's exactly what this means right down here. Now it starts to bounce, and now it starts to move. Now, as it starts to move and climb that hill, there are going to be periodic clusters. There's overhead supply that has to be chipped away. There's buyers underneath who want to grab it on a retrench or what we call like a retracement. So what you need to do is you need to periodically just draw support and resistance levels. There's one right there. See that gap and go where it gapped down and crashed and burned? Okay, there's a now when it's going to retest that resistance. That support now becomes resistance. But if it can get through that support and that resistance, old resistance becomes new support. So over here, that's new support. Over here, that's resistance. Oh, wait, we got through it. Now you got new support. So there's support one here. There's support two there. So you're basically scaling this mountain is what you're doing. This is what you need to do. It's like one part of the exercise. Now it's going to retest or it collapsed from this big fat Mariposa. Now there's another resistance. It consolidates right there. It breaks through. Now it starts to run up and it keeps running and running and running until it retests this old 236 level. Then it retrenches itself, doesn't fully test this support level, pulls back about 2/3 the way, and then it starts up again. So what you're effectively seeing is, and it's not that hard to construe. It's not. Stop, please. You're like, oh, look, you're pulling up. You're zigging and you're zagging. Look, you're just zigging and zagging. You're zigging and zagging. So in that zigzag pattern, you have periodic way stations. That's all you're doing. You're periodically hitting points of support, and then you buy off the support and you walk it further. It's a stair-step pattern. It's an escalator pattern you're walking up. This is the most, like I said, technically artistic. I call it artistic because it's optical. It's an optical, not illusion like it's fake. It's an optical illusion because you're alluding to what? Levels where you're being defended by algos, institutions, retail, and prop traders right at these levels. To me, the key is, and I can take each one of these off. I'm going to remove the zigzags off. The key is to draw these support levels. Why? Because these become your point of departure. I call it the point of no return. So if you're out here, anywhere inside this channel, anywhere, just draw the support of any friggin' stock. I don't care. Just draw it. Why? Because if it goes through, you've got to do one of three things. Get rid of all of it. Get rid of it. Because once you fall through that trap door, okay, it will it's like a magnet. It goes from one magnified area to the next one. It just keeps moving through. If it breaks through, then logically it will try to retest the next level. It moves through channels. That's all you're doing. So you have three choices. Get rid of all of it, get rid of some of it, or just buy a put option. Those are your three options. That's it. There's not more you can do. Don't add more. That's what the doom costs do. You want to lose all your money? Keep dollar cost averaging into losers. I guarantee you won't survive a few months in this. When you lose, you put your head down, you lift your head up and say, okay, look yourself in the mirror. I screwed up. Get me out. Next trade. That's how I do it. I have a very short-term memory. The losses, they will happen. You're going to have to deal with them. The only time I would not pull the trigger, I call it like it's contextual. If it broke through a support, depends upon the valuation metric of the stock. Boeing has an outrageous valuation metric. It's all over the place. It's 70 times earnings. It's 80 times earnings. It's 20. Boeing is a touch and go dynamic nightmare. I've lost so much money trading this. I'll never trade it from now. I don't care if I'm 90. I'll never trade it. I won't trade it ever. I'm not going to buy it or sell. I hate this stock. I've lost enough money to avoid it because nobody in the world knows how to trade it. Either you buy it and you pray or forget it. But if you decide to trade a stock like Boeing or anything of its, I call it its ilk, where it's like of its ilk is something like, it could be Dash. It could be something like Oklo. It could be Palantir. Good luck, because you and I know you have no idea. You're guessing. I never guess. If you want to guess, then trade something like this. I don't guess. This is a guessing game. So to avert risk of ruin, just step in and cut your losses. But to cut the losses, you have to be able to draw horizontal lines. You can go about it in many different formats and fashions. Like what? Uncle Jeffrey always comes with the proof. This is what we call on the Thinkorswim platform, the horizontal price level. It's flat. You don't like that? Don't worry. You're not going to hurt my feelings. There's many ways to go about this. How else might I do it? You could go about it and use the rectangular tool. The rectangular tool boxes in the channels and basically captures duration and not just the y-axis. It gets the x-axis, which is time. It gets the y-axis, which is price movement up and down. And it captures it in a beautiful escalator sort of like fashion. You can see it. It's got duration and it's got price appreciation, depreciation built into it. So you can use rectangles, you can use horizontal price levels, or you can try your hand and say, I just want to go trend line and draw it sideways. You can do it that way. Just make sure you get it set to 0 on the actual angle, on the data box shows 0. So there's basically 3 ways to do this: trend line, horizontal line, or rectangle. How you do it, Jimmy Crackhorn, and I don't care. It's totally up to you. It's your life. It's not mine. I'm not you. I'm me, and I'm thankful for it. All right. Next on the list, because you know what? You wouldn't want to be me either. All right. Here's the next one. There's another way of doing this. You're like, there is? Yes. If you want to throw your hand in the ring, and I'm just throwing it out there, you have to establish levels where you're willing to exit. You could just as well do a Fibonacci, or you could do a Fibonacci extension. Fibonacci's I find work for 9 months or more. Fibonacci extensions work for 9 months or less. So at the risk of this, I will choose the Fibonacci extension. If you want to learn more how to draw a Fibonacci extension, you're going to have to access my archive, my personal archive. So here, click A, go all the way to B, and then lock down at the lower level, which is the retracement there. And now I've got a Fibonacci extension configuration. There's the 78.6, the 61.8, the 0. Okay. Understand, my job here is to educate you and show you there's not one way to do this. If somebody says, if it's this way or nothing, fire them. Get earplugs. Never listen to that stuff. There's never one way to, there's a million ways to do things in this business. There is. Okay. This happens to be the Fibonacci extensions. You might want to do another Fibonacci. Who knows? I'm just providing the optic. I'm providing the tool. I'm providing what I call like the idea of how to protect your mistakes, okay? Or could be your gains. Let's say this one starts rallying and it gets all the way up to that 50% retracement. And you say, I'm buying into the Fibonacci extension theory. Okay, here we go. 38.2% would be your exit. You'd set your stop right there. There's your stop. Now you're going to come to me and say, but Don Kaufman taught me never to set a stop on a spread. No, you're not setting a stop on the spread. You're setting a stop on the underlying stock, then deferring to the price of the spread and then selling at a limit. I would never sell a spread at market. Are you joking? You're defining the risk by the spread. What I'm saying is the price of the underlying will configure into a formula that will show you the value of the premium of the spread itself. So if it breaks and I'm in an option, I can then exit the option spread at a limit price. That's what I mean. But notice here, I'm using horizontal price levels to protect gains or to protect losses. Okay? Put aside your ego. Stop. I don't care. If it goes through, then consider getting out. At this level, you could have said, damn, I bought it at the 50. It's coming to 23.6%. You could either say, I'm going to exit all, exit a portion, or just just buy a put option to protect on a stock like this. Here's the thing. Once you broke underneath that, it went right to the figure. And once you broke hard underneath that, it went right to the figure. So what if you said, I stopped out here? Then you're out. But it didn't work. You don't know that. This could have gone to zero. Don't play Monday morning quarterback with me ever. I'm never going to listen. You don't know. It could go straight there, straight through. You don't know. It just happened to bounce. And even though it bounced, it still came back and went through anyways. And now it's going down there again. So your argument falls on deaf ears for me. You cannot predict what's going to happen each day with a stock that's this wild. So at the risk of like protecting your account, because Don conceived of this company, what's the whole theme when you go to the TheoTrade website? Protect capital. This is what we do. This is what we do best. My best thing, that what I do best is I protect you from getting killed. This is one of the ways to do it. Just set not stops, but you set what I call mental stops, or you set auto stops on stocks, and you say, hey, look, I will give it $2 or $3 leeway. You can do a stop limit instead of a stop, because a stop rolls to a market order. A stop limit rolls from a stop to a limit, and if the limit's not hit, the trade won't be filled. It gives you a little bit of flexibility and a little bit of control over the price if you were to hit a stop. But you need to establish stops as resistance, as if it were a put option underneath. It's imperative. But don't live your life, okay, in this, what I call horizontal cage. And people are like, what does he even mean by that? Okay, it's always good to have these horizontal levels. There is no doubt they're great to have. But there are times when you're going to realize that certain stocks aren't choppy. They're not choppy. That's choppy. These are lumpy. Up, down, up, down. Look at the volatility. There's a lot of volatility here. What about stocks that don't have a lot of vol, where they go vertical, okay? But you got to have a stop just in case it falls out of a window and never comes back, okay? That's where I preach to you. You have to start using trend lines or channels. That's a channel. That's a trend line. My preference, mine personally, is I use channels. I don't use trend lines. I like channels because I like to see the top of the channel, the bottom. I like to see resistance. I like to see support. The bottom of a channel, by definition, is support. The top is resistance. But we're not talking horizontal configurations. We're talking about angles and slopes. So if you were to pull out the good old trusty channel tool here, you would connect logically the higher lows to the higher lows. This is what you're doing. Look how I connect this. This would be technically your channel. And here's the logic behind this, okay? There are times when you'll sit there and say, your total focus is horizontal. Nothing wrong with it. It's all good. I promise you. It's like, all I do is horizontal. It's fine. But when you use horizontal, you tend to give up a lot more slippage than you realize. Like if I just use horizontal and I had bought here, well, logically, I would blow out at 215. So I bought at 240. I sold at 215. I lost 25 bucks. Instead, what would have happened if you used the ascending channel, which is what this is? It's an ascending channel. Okay. Would you have lost money? You bet you would have lost. But you would have lost a lot less money by what? By looking at the slope rather than the flat slope. Look over here. Even if you stepped in and said, Bierman, I bought on the breakout up here because Bank America put an upgrade on it. Yeah, you sucker. You bought at the top instead of buying at the bottom. But of course. So you buy right there. 238, 240. Okay. Your stop is right there. That's your stop. Why? Because if you go through that stop, it's a trap door down to Hellsville at 215. You can see that. So what I always preach to clients, and I teach this in the mentorship classes, always draw not one, but two lines of defense. Your first line of defense is the ascending channel when you're bullish. Your second line of defense is the horizontal price level tool. If it breaks that, get out of half. If it breaks that, get out of all of it. It's that simple. Or if it breaks that, get out of all of it. Or if it breaks that, just buy a put option. Buy the put to hedge off the loss because you don't want to exit the Boeing because your ego is so fragile. Just do something. You can't let this happen. If you worked for me and I saw you didn't protect this, I would have fired you. You cannot let this happen. This is the kind of stock, I call these widow makers. This is the kind of stock that bankrupts you. It literally turns you upside down and makes you look like you know nothing. Even the smartest people I've worked with, okay, get so caught up in like, I made so much money. And then like, I made 100 grand. Yeah, at the end of the year, it's down to 20. How does that happen? Because they get overly confident. It's called heuristics. They get spoiled. It's a conditioning. It's a confirmation bias. They get conditioned because, well, I made money on 12 straight trades. Do I need to listen to Bierman? Do I need, you don't think you ever need to protect. You make money so easily that there's no need to protect. And then you get schooled, you get exposed, you get embarrassed, and you blow your account. I am not paranoid. I'm not. I am not a worrywart. I just do one thing. I plot the loss while I'm doing the trade. I'm like, okay, this is the point where if I lose money, this is as much I can absorb the pain. And what I tend to do is I draw the ascending channels and I draw the horizontal lines. I just look at them and go, okay, that's where I'm bailing. That's where I'm hedging. That's why when you look at the Genesis COG, like the worst loss we have is like 10%. And that's rare. Like I lose 3 and 4%. But when you have these 30 and 40% losses, those are like, you don't come back from that. Those are called 8 balls. You're behind the 8 ball. You're not coming back from that for 6 months to years. You lose. You start with 100,000, you lose 33,000 on a trade. You're not coming back. I don't care how many, you can make 100 trades. You're not coming back because you let one run away on you. You can't do that. You don't need to be like, penny wise and pound foolish. You don't need to be paranoid. You don't need to be like crazy. Like, I gotta try. Be calm. Just recognize where the risks are. The risk is right. That's the pressure point for the risk. If you go through that, you're likely going to break through to the next support level. And it doesn't matter what stock you take out. It doesn't even matter. I don't even trade Nvidia. I don't even trade it. I don't. And I can look at it immediately and tell you what the risk is. I can walk in here and in less than 15 seconds plot this. Overhead resistance, support to here, support to here, support to there. And then I can walk in and do this. I can do this literally. I've been doing this forever and you'll teach yourself. Look, there you go. Now what? Simple. Go ahead and trade Nvidia any way you want. Buy it or sell it. I don't care what you do. It's your money. I'm just telling you, if you take out that support, you're going to get burned. Whoops, there it is. Told you. Once you break these ascending channels, it's the kiss of death. You have to get out of these things. The only thing that you can hope for is a sideways flag pattern. A flag pattern is this. This is a flag pattern. But if the flag pattern doesn't hold on the ascending channel, good night, you're dead. Look, now you believe me? Nope, too late. You bought at 225. You're now at 209. You're down 16. There goes your option. Boop, it's over. You're not making your money back. Even if they report, you're not going to make your money back. The best it may do is get to 220. You have to constantly plot ascending channels, okay? Ascending channels with horizontal all the time, not once, on every stock. That's why when I wake up in the morning, I never get flack from the Genesis COG people because I'm watching every single pressure point all the time. As long as it holds within that pressure point, okay, no worries. No worries. But if it breaks the pressure point, I have to make a move. I either got to say, let's get out of a quarter, let's get out of half, do what? And I'm talking about to protect against losers and protect against winners. You have to take this type of posture. This, I can do this. You can send me anyone you want. I can plot it in 15 seconds and tell you what the risk is. The steeper the angle, the more money you can make. Yay! The more money you lose quickly. Remember that. The slope will make or break your wealth. I teach this 30 years. If you don't follow the slope, you will never survive. Everything the Genesis COG owns, the slope is low. That's why we never lose a lot of money. I don't buy high octane stocks, so I don't have to face the Genesis COG people and go, I'm sorry, I lost 30%. Now, never going to happen because I don't take that type of risk. I don't want it. but I obsess over risk over reward. The reward will come. It always does because I buy stuff so cheap. The question is, what happens when the market doesn't respond to what I think is cheap and takes it down? I have to respond. And the way I do it is I just plot these channels. Don't take this at all for granted. You need to identify support levels in bullish charts. You have to. And even in a bearish chart, you should do it because if that support level's taken out, it'll make another leg down. It's like a trap door that just opens downward. So you need to identify them. The way you do it, again, channels, rectangles, trend lines, or you could do, again, the basic one. Just go play. I'm going to be formulaic. Go ahead. Use the Fibonacci extension. Go for it. Here's the Fibonacci extension. Ready? Fibonacci extension does this. It's A to B. Goes A, okay, to B. There's your Fibonacci extension, which means that if you had bought, say, I'm going to buy on the dip right here at 217. It's pretty simple. If it takes out 214, you got to bail. Why? Because the next stop is 210. Now you're at 210. Now what? I don't know. But if you don't hold 210, you're going to 205. What I simply do for you is I take away, there's no guessing. You know exactly what's going to happen if levels are broken. You can sit there and go, if that's broken, it'll go there. If that's broken, it's likely to go there. Yes, that's what they do. Markets are not as random as you think they are. They're not. They tend to move in certain patterns by horizontal or by angle. This just happens to be a formulaic horizontal pattern where it's falling in sequence. I told you, once a channel is broken, okay, the bottom side, it's like opening up a horrible trapdoor. You haven't, and none of you have seen anything yet. Wait till you see the S&P break 7,300. You're going to go, oh no! It'll break down so fast you'll never respond. It hasn't broken a trapdoor yet. That's why I call it a cliffhanger. But a lot of stocks are out there that are just completely breaking down. I'll bring a last one out here. It's the last one I'll bring out here. Here's AMD. I haven't even looked at AMD. Okay, here's AMD. Did it break underneath? So what do you do at this point? Simple. All you do is pull out the old rectangular tool, draw your flag formation. You have risk all the way down to 422. So right now you have a $32 risk to the downside. Next question. You can say, I can do this for you all the time, but I don't want to do it for you. I want you to do it for yourself. If it goes through here, it's the end of the bull run for this stock for a very long time. You'll not see it come back because everybody who bought up here, his overhead supply is stuck. You could plug anything. You could plug Fibonacci's in there. You could plug whatever you want, but you should always do two things. Plot the horizontal levels. Look, resistance, support. Here's more support down here. Look, here's support here. There's support there. There's support there. There's support here. Volatility map. If you can volatility map like me, this will cut down, this is a guess, 25 to 50% of your losses will evaporate in an hour. You're like, oh my God, instead of me losing 20,000, I've only lost 5,000. Volatility mapping is not about predicting what's going to happen. It's about containing the damage. Because if you can contain the damage and grow the winners, you'll become a millionaire anyways. Don't always think you're going to win every trade because you're not. Tomorrow, we'll talk about the bearish flag formations and the bearish protocol or tools you have in front of you to contain both long and short, more importantly, short squeezes against you. In the meantime, I'm going to turn this over to Brandon Chapman. I have got to do a burn signal monthly call at 12 o'clock today, which gives me a chance to grab some lunch. This has been a phenomenal day for me, both long and short. Because I went in when the longs popped, like when Fitbit popped, I shorted it. When my shorts popped, I shorted more. Why? Because there's no upside for them. They're trading at 30 and 40 times earnings, and they're not even growing in anything. Now I'm waiting for Brandon Chapman to come in. And yeah, a lot of my laggards, and when I got guff last week, are also breaking out really big time. Mainly the longs are breaking out. Some of them are up $3 and $4 today, which I'm really happy about. It's like I bought them for nothing. None of you would ever buy the stuff that I own. Only the Genesis Cog people will. Why? Because I buy them because they're so stupid cheap, and money managers, they only buy financial porn. I buy ugly charts that turn beautiful eventually. Anyways, Brandon Chapman, this is an interesting market. I call it the cliffhanger. We're not breaking down yet. The advanced decline's positive, But as the day's wearing on, Mr. Chapman, the advanced decline's gone from 17 to 8 to 13 to 12. Do you see a seminal change in the market by market breadth, or do you see a problem in the market with percent? Do you think we're at the edge of a cliff like I do, or do you think we're going to make a leg up? What say you?
Well, I mean, if you follow institutional hedging activity, it's been pretty extreme for the last couple of weeks, right? So we've got a VIX vertical spread on, and Block Hunter, we shorted energy on Friday. XLE, we're up about 72% right now.
Nice.
So I mean, look, yeah, I mean, and we're going to talk about gold today, but yeah, I mean, it's a look. I mean, anytime the Treasury has to step in to intervene in the bond market, that's never a positive, right?
No.
I mean, you may interpret it a particular way, but the market may look at the liquidity side of it. We're going to talk about that today. They're dipping into the general account. But yeah, I mean, it's never a positive thing when there's that much stress where they've got to put billions of dollars of work to keep the bond market going.
What torques me every day I walk into this business is it's like I always say, I'm sitting there going, really? Not again. It's like, let's get out of financials. No, wait, let's get back into financials. It's like they just can't like let it go. It's like once we blow the tech out, we'll find another sector to lift up, even when we know it's a bubble. It's this constant
Well,
rotation. It's terrible.
I mean, the banks have so much exposure to debt, right? To treasuries
Oh my
that
God.
so if the Fed's gonna if sorry the federal government's gonna intervene and support the treasury market, treasury's up today, so financials are up, right? So last week it looked like we're starting to roll over, but then they stepped in and they're gonna step in again, right? So it might be hard to short financials for the time being, but when the market breaks, they're gonna break with it because
Yeah.
inevitably you don't have enough fingers to put in the dike to solve the debt markets right now because we've just had 40 years of awful policy.
Yeah. The only thing I think that saves them, at least for me, is every stock, Brandon, I'll leave it this. Every stock I'm long. I'm long about 10, 11. They all have one thing in common. The highest multiple on any of them is 10.
Mm-hmm.
That's why I don't care if the market falls 2,000. I will not lose that much money. It will not happen because the multiples are so low and the growth rates are still there that they will become automatic hedges. You will rotate to these stocks, and that's what's happening now. While other stocks are compressing their multiples. So I always say that value means nothing in the short term. You don't have to explain it to me. But in the long term, value, whether you're a growth or a value player, that's the most important thing is the fundamentals, always.
Yeah, I mean, as long as you want to hold through the drawdown, right? So, I mean, if we go from rotation to liquidation, so if people start to pull money out of their 401k because they have to, or they get fired and they need to spend it, or they just want to lower exposure, I mean, everything's going to draw back. But yeah, stuff like staples, for example, will outperform the S&P 500 in
Sure.
that pullback. It's just a matter of, okay, how much of a drawdown can I sustain, to collect dividends or other things that might keep me afloat and make me feel like I want to hold it. But this is definitely a point where you got to hedge the downside risk a little bit.
I couldn't agree. I couldn't agree more. All right, man. I'm going to turn this over to you. I'm going to make you the host. If I haven't, I will promise I will get onto it. Come on, baby. Here we go. Where is this? Here we go. You're still not the host, right? I will give it to
No,
you, I promise. Brandon is now not the co-host, but he's the real host of the show.
there we go. You got
All
it.
right, man.
Mhm.
Run with it. See ya.
All right, have a good one. All right, let me share my desktop. We'll start to fire away. So, what are we going to cover today?